Welcome and thank you so much for joining us here today. If you are not familiar with me, my name is Allison Moore and I work directly with our amazing team here at Hutchinson to help bring you information that is helpful and relevant to the current market. Today, I have the pleasure of being with Todd Walker. Todd is their senior portfolio manager and is in the day-to-day management of our client portfolios. And today we are going to talk about structured products and how they help diversify our clients and set us apart at Hutchinson from others. So Todd, how are we using structured products in our clients' portfolios these days?
Well, thank you, Allison. The way we position structured products in our clients' portfolio is we're trying to accomplish above average monthly income for our clients with defined potential downside protection. And that is what we refer to as our income notes. Our number one goal is to provide defined downside protection. Now, once this piece has been achieved, we then ask ourselves, how much income can we generate with a minimum amount of predetermined risk? We marry these concepts together, and typically we're able to provide a 9 to 10% annualized returns on those notes, with the probability that one individual note might fall below that 40% barrier at a very low rate, less than 10%. Due to that, albeit low possibility of failure, we will ladder the notes with different maturities in order to make our risk levels go even lower for our clients.
Gotcha. So who would you say these structured notes are for?
Structured notes that we work for are designed for who we classify as sophisticated investors. The term doesn't come from the investor's market knowledge, but rather the goals the specific investor has. For instance, above average growth with downside protection or above average income with downside protection. And due to the complex nature, structured products are only available through the use of a financial advisor or through a firm like ours, and they often come with a set minimum investment. At HFO, we not only have access to these type of products, but more importantly, we have the ability to individually customize our structured products to fit our client's specific needs. And this is exactly what structured products are designed to do. They provide defined incomes, the interest rate or percentage per month, with the predetermined downside protection risk, which is the 40% in our case. And this is why we feel comfortable deploying them in our clients' portfolios.
So you mentioned that they were a little bit complex in nature. And for those of us that are a little bit more visual, can you give us an example of how the structured products work?
Yeah, let's take a minute to go through some individual examples and different scenarios of an income note and a growth note. You can see in this particular example, we're looking at a 3-year note, and we normally do 3 or 4 year notes. The underliers are the S&P and the Russell, and each week I go out 2 to 3 times a week and get pricing from the different investment companies, and I give them the same parameters, and they come back to us with different rates, coupons that our clients will get on an annualized basis. And I'm able to cherry pick these and try to come up with the best particular situation for our clients to help them achieve their goals. The principal on this particular note is down 30%. Like I said, we normally do 40, and it's auto callable, which means either at a 3-month period or after 6 months, that if we're trading for 1 penny more than what we paid for them, then we will be called out and we'll have to look and replace that note. And for this particular parameters, they're going to pay us 8% per year on a quarterly basis. So let's look at the first scenario. In the first scenario, we go along for the entire 3 years. It stays within our barriers, and you can see the barrier 30% downside protection in this illustration, and where the 0 is, that's what we pay for the notes. It stays within these parameters. So we get all of our coupons, which are 24%, plus a return of principal with 100% of our money back. In the next example, you can see in quarter 5, the note is now trading for more than what we paid for it. So in this instance, our clients would get their coupon for that quarter, plus they would get a 100% return of principal. So over the 5 quarters in this illustration, we've got 10% coupon payments plus 100% return of principal. In the next scenario, you can see in quarter 6, we went below our barrier. And so in that particular instance, we will not get a coupon payment for that particular quarter. And then we continue to see the next quarter, we're back above the barrier, so we continue to get coupon payments. So at the end of the 3-year period, we would have gotten 22% from coupon payments and 100% of our principal back because we finished above the band. In the last scenario, you can see at the end of the term, we finished below the barrier. The underlying index, the worst one was negative 33%. So at that point, we typically would be priced at whatever the note was pricing for at that point. So you can see it'd be negative 33%, but because we received 20% in coupon payments, we would only have a 13% loss on principal. Now, we've been doing this almost 3 years, and thus far, knock on wood, we haven't had any notes breach the barrier. If we ever had any notes coming close, I would typically go in, buy the note back, or have the note bought back from us, from our clients, and go back and reprice and go back into the market at better levels. Now, in 2023, the market started coming back and started doing well. So we decided that we wanted some growth potential in the notes and not just income. And so we started utilizing some dual directional growth notes. And in these particular investments, we have one underlier. We usually use the S&P 500. The term is 2 years. We normally go out 2.5. And you can see in this particular example, we have 100% upside potential and 100% downside with a performance cap of 24%. And the last factor is we also had a downside protection of negative 20% to the market. And you see in the first scenario, at the end of 2 years, the market returned 30%. Since we have the 24% cap, our clients would all get 24% plus 100% return of the principal. In the next scenario, at the end of 2 years, the S&P was up only 20%, below our cap of 24. So we fully participated in the upside of the S&P. So we got 20% return plus return of capital of 100%. And then the unfortunate situation that the S&P is negative at the end of 2 years, and you can see in this example, it's negative 16%. Since we had the 20% protection buffer, our clients would receive a 16% return plus 100% return of principal. In the last scenario, the S&P was down 32% in 2 years. We were buffered and protected down to the first 20% of that 32. So our clients ended up with a loss of 12%. Now that doesn't sound good. A loss is always not that great, but this is money that would have been in equities anyway. And so I would a lot rather be down 12 instead of 32% in that case.
So what would you say, Todd, are risks associated with these structured products?
Well, that's a good question. There's 3 primary risks. The first is issuer credit risk, and that's the risk that in a crisis, the issuer of a note becomes insolvent. So think of JP Morgan going under or Bank of America going under. So one of our first screens is to make sure that we only use credit, banks that have very good credit ratings and low potential default risk. The second is market risk. And due to the investments being linked to different indexes in the market, investors are taking on the risk of the underlying indexes the notes are linked to. And then finally, there's opportunity cost. And due to the fact that these investments are designed to be illiquid, they can underperform other investments over a set period of time. So that's the main risk associated with these investments.
Gotcha. So why would we utilize structured products now?
Good question. Typically, portfolio managers have relied on the 60-40 model, the balance model, the golden ratio between stocks and bonds to allow portfolios to have upside opportunity while being able to dampen the downside exposure should we experience a market pullback. Well, unfortunately, during the last few pullbacks, the global financial crisis, the tech wreck, COVID-19, and years like last year in 2022, we've started to see stocks and bonds move in the same direction. And so thus we're not able to provide protection that we need in a pullback year. For instance, in 2022, the S&P was down between 19 and 20%, but the bond index was also down between 14 and 15%. So really there was no place to hide. And the structured notes that we have used gives us the ability to get above average returns by providing a higher level of protection on our portfolios. And so, our main goal is to try to protect the hard-earned assets that our clients have grown over time because they entrusted us with those. And what I'm trying to do is eke out any kind of return I can, but protect them and make sure we don't take on too much risk in the portfolio. One of the other questions before we finish is I get a lot of questions on the pricing of these notes. And whenever we buy a note, it's going to price on your statement at $100 a share. As those underlying indexes go up and down, you're going to see that number move up and down. Well, just understand, we're in these for the long term. They're either going to have 2 different conclusions happen. We're either going to get called out early, which we're having a lot of that happen now. Typically, average on industry average on a note being called is about 8 months. That's going to vary based upon, different market conditions. But our primary number that we're worried about is what's the worth or what's the value or price of that note on the day it matures. And so that's the main thing that we're concerned about. So you're going to see the prices fluctuate on your statement. Don't be that concerned. But if you do have questions at any time, feel free to give me a call and I can walk you through everything that we are watching. And believe me, we are looking at these on a daily basis, and we're trying to make sure that we put our clients in the best position to be successful and to help them achieve their goals.
Well, thank you, Todd. That was super helpful for just walking us through what structured products are, how they benefit our clients. And for you all, these talks are designed to bring you information and education. In the past, you have asked if you can share this information with others who you feel would benefit from it and what we discussed today. And the answer is yes, you can share it with anyone you think that could bring some insight or education to. If you are interested in going into more detail about anything we discussed today, or you have questions about the content we discussed, you can contact our office or book some time with Todd, as he mentioned, get on his calendar, or reach out to us and let us know how we at Hutchinson can help. Thank you again for joining us, and we look forward to talking to you soon.